Income tax is that percentage of your income that you pay to the government to fund infrastructural development, pay the salaries of those employed by the state or central governments, etc. All taxes are levied based on the passing of a law, and the law that governs the provisions for our income tax is the Income Tax Act, 1961. Income tax is only of the direct means of taxation like capital gains tax, securities transaction tax, etc., and there are many other indirect taxes that we pay like sales tax, VAT, octroi, service tax, etc. Income tax you pay every month or upon every contractual earning is what forms a large part of the revenue for the Government of India. These revenue functions are managed by the Ministry of Finance, which has delegated the responsibility to managing these indirect taxes, like income tax, wealth tax, etc., to the Central Board of Direct Taxes, CBDT. Get your credit score free in less than 3 minutes. Get it now. Income tax. Income tax is applicable for individuals, businesses, corporate, and all other establishments that generate income. The Income Tax Act, 1961 regulates the collection, recovery, and administration of income tax in India. The government requires the tax amount for various purposes ranging from building the infrastructure to paying the state and central government's employees. It helps the government in generating a steady source of income that is used for the development of the nation. The income tax is paid every month from the monthly earnings, however, it is calculated on an annual basis. The amount of income tax an individual has to pay depends on many factors. Income Tax Department under the Department of Revenue of the Ministry of Finance, the Income Tax Department, IT Department, is responsible for monitoring the collection of income tax, expenditure tax, and various other financial acts that are passed every year in the union budget. The Central Board of Direct Taxes, CBDT, regulates the policy and planning of taxes. CBDT is also responsible for administering the direct tax laws through the IT department. In addition to the collection of taxes, the IT department is also involved in prevention and detection of tax avoidance. Changes brought about in income tax in the Union Budget of 2018. Finance Minister Arun Jaitley, in the Union Budget 2018 session yesterday, the 1st of February, proposed 5 new changes to be incorporated to the existing standards of the Income Tax Department. A 1% increase in the cess of corporation and personal income tax was proposed by the Finance Minister in the session yesterday. From an earlier 3%, the cess has now been increased to 4%. This, in turn, will spiral the total income tax paid by a taxpayer every year. Salaried individuals, henceforth, will get a 40,000 rupees deduction on their incomes, thereby replacing the existing exemption permitted on reimbursement of medical costs and transportation allowances. Around 2.5 crore salaried individuals are believed to benefit from this move, and the total cost incurred by the government would amount to 8,000 crore rupees. In the year 2006-07, standard deductions on incomes were abolished, although soon after the concept was brought back into action. Standard deduction essentially comprises of deduction of a certain amount of money from the salaried individual's income to cope with expenses that the person would incur during his employment in the organization. The Union Budget 2018 introduced a new 10% tax charged on investments of long-term capital gains in stocks and equity mutual funds. Contradicting hugely from its existing standard of tax exemption, the new tax law states that all profits exceeding the amount of 1 lakh rupees from mutual funds and stock markets will henceforth be taxed at 10% rate. However, long-term capital gains that have been invested in stocks and mutual funds up until January 31, 2018 will be exempted from any tax deduction. The Finance Minister in the session of Union Budget 2018 held yesterday also introduced a 10% tax rate on distributed income earned from equity-based mutual funds. Concerning the senior citizens of the country, the Indian government has established a lot of changes that will help minimize their financial burden. The exemption of interest income on prepayments made in banks and post offices has been increased to 50,000 rupees from an earlier 10,000 rupees. Under Section AD, the deduction limit for premiums paid on health insurances or other medical expenditures has been increased to 50,000 rupees from an existing amount of 30,000 rupees. No deduction of TDS under Section 194A. Availability of benefits for interest received from recurring and fixed deposit schemes. In the budget of 2017, several changes related to income tax were announced. These changes will come into effect from April 1, 2017. Some of the important changes are as follows. The income tax rate for people earning 2 rupees, 50,000 to 5 lakh rupees per year has come down to 5%, but people earning over 50 lakh rupees per will have to pay an additional surcharge along with the applicable tax rate. The surcharge is 10% for people earning an income of 50 lakh rupees to 1 crore rupees, and the surcharge is 15% for people earning an income of over 1 crore rupees. Filing of ITR will become easy for people earning up to 5 lakh rupees as the government will introduce a simplified one-page form for them. People who file their ITR using this form for the first time will not be scrutinized by the Income Tax Department. No deductions can be claimed for investments